Hello, and welcome to the Invest with Carl podcast. Today, I'm Jamie Uppenberg, your host and a member of the Carl team. And today we're chatting with Cy Smith, who is a co-founder of Carl, actually, and he's also our current president. So we're really happy to have him on the show today. I will introduce Cy. Cy is a serial entrepreneur. He has had several successful exits, and he's currently involved now with several companies, and he sits on the board of several companies. And I do know that Cy's passion is technology and data. So he loves to make things simpler, and he loves technology to move things into all new arenas and make them more accessible, which is one of the appealing aspects for him of Carl Investments. So we welcome Cy today. Hi, Cy. Welcome to the program.
Hi, Jamie. Thanks for having me, and thanks for chatting with me for a few minutes.
Yeah, I'm really excited to be with you today. And today we are talking about something that we talk about on occasion around Carl offices, or the Zoom offices of our remote spaces these days, which is there are really two types of investors out there. And we have a tendency to say we have the investors who want to get rich, and we have the investors who want to stay rich. And while you may, put investors in many different other categories, and many of you have either had one-on-one meetings with me, or you've heard other episodes with me, and we've talked about different types of investors, but we tend to sum them up in these two categories. And Cy, I was going to ask you today, can you kind of explain these two categories? Like, what are we talking about?
Sure. So traditionally, those two categories are easy for advisors, financial advisors, to classify investors. And it basically boils down to those that want to stay rich, or those that are going to be a bit more conservative, or are thought of as more conservative in their thinking and in their investment strategies, because they're looking for ways to preserve wealth that they already have. They may think, well, we don't really need to grow that wealth, but we want to make sure that it doesn't disappear through the various market cycles that we may encounter. Those that want to get rich are those that may have a small amount to invest, and they would like to figure out a way to grow their wealth. Now, obviously, both categories would like to do what the other categories are doing, as long as they don't sacrifice or compromise their ability to do their primary objective. So those are the things that I think about. And I guess, one of the things that led me to the idea of Carl and co-founding it with my partner Gunnar is we feel that you don't really have to compromise one or the other, that there are smarter ways to do things in the age of technology, in the age of massive amounts of data, and in the age where data can be evaluated and analyzed very quickly. And those two types of investors can really enjoy both of those objectives, which would be let's get richer and let's stay rich as we get there.
Right. And I think some of our listeners have heard me talk about the risk profiles of investments. So when you say they can do both, is that part of what you're talking about? That they can, I mean, if I'm hearing you right, they can take on less risk, but maybe have, still decent gains, and on occasion, some strong gains within an investment. Do I have that right?
Exactly. Yeah. The thing about Carl and its portfolio of investment opportunities is that you can actually, all of those strategies are designed to minimize downside risk and maximize upside potential. So if you can do both of those things, and that's where you can get richer and actually stay rich along the way. So the unique aspect of data analytics and the ability for computers and scalability of those computers to process that data is such that strategies can be developed that would actually measure and monitor if there are risks that suddenly enter into the marketplace that might pose a downside threat. They can be mitigated or eliminated through data analytics in a very timely fashion. It could be minutes, it could be a couple of weeks, but it's just having the ability to monitor what's happening in the marketplace globally, broadly, as well as individually with specific companies. That's what these investment managers will actually do that have developed these quantitative analytics strategies to help investors with that. And at the same time, they're going to look for trends and patterns to say, under these market conditions, these types of investments are going to go up. And they'll actually do more than just tell you these types of investments are going to go up. They'll make the investments for you, and then they'll get out of those investments when those trends may change.
Right. So they have many systems, large systems, analyzing very vast and large amounts of data, right? That's part of Carl quantitative strategies with that we have on the platform now and are looking to add more in the future, much more than human beings can process, obviously. And so keeping that in mind, and we do like to have investments that cover both sides of the types of investors we're talking about, which is the get rich and the stay rich, at a high level. Do these investors, those, look at some of the Carl investments maybe a little differently, or do they see them exactly the same if we're looking at some of what Carl has in the platform now?
They're definitely going to look at them differently. For example, I was talking to a guy who was a few years out of college, is just coming into some discretionary income as he's starting to earn more. And he doesn't have a lot saved up. So he was asking me about investment strategies and should he just invest in some stocks? What kind of stocks? He's looking for and talking to friends and say, hey, have you got a hot tip for me? Well, that's kind of like throwing dartboards. You never know what an individual company is going to do or what kind of announcement may come out the day after you invest a lot of money. But he was looking to get rich. He was saying, look, I'm getting married in a year and I'm trying to figure out if I can put some money into an investment or a portfolio of stocks, save enough money, for my honeymoon, make enough money for my honeymoon so I can go on my honeymoon. He's not thinking about retirement. He's not thinking about how to protect his massive wealth. He's really doesn't have anything saved up. So he's looking to get rich. Younger guy, how do I make money so that I can actually cash in maybe in a year or 2 years? That's one category. Other categories could say, I've got millions of dollars and I live off of income from those dollars because I'm not working any longer, or I've inherited money. And they're looking to say, yeah, I like the idea of Carl. I like the fact that these hedge funds target returns that typically would outperform any market indices. However, they also wouldn't mind growing their investment along the way as well. So again, getting richer along the way, but they're more interested in saying, I want to protect it. So they may choose or build a different portfolio that perhaps has less volatility with less upside potential. The younger investor.
If I hear you right, the investor who's looking to stay rich is going to be maybe a bit more focused on the risk profile, the downside. They're looking to say, hey, look, I could invest in the market and let it all ride the market. The market does very well, but then I have to take the day where the market's down 20 to 30% in one, wipe, because it happens, right? It happens every couple of years, sometimes a little more frequently than that. So they're a little more sensitive to that, if I'm hearing you correctly.
Exactly. And the great news is Carl is really the only platform that I'm aware of that will provide all of those statistics that would let an investor make an informed decision that matches his risk reward profile.
Right. All of the stats are right in the app, and they can take a look at the volatility and the worst drawdown and the I hope I have the language correct to the app, but
you do, yeah. Or the recovery period. If it's had a drawdown of 16%, but it recovered in a week, then maybe that's not too bad. If it's had a drawdown of 20% that took 2 years to recover, then that's probably not a strategy that someone who's looking to protect their wealth would be interested in. On the other hand, if it's getting a 40 or 50% annualized return, you may have a younger investor that says, I want to put some of my money in on that one because I'm really looking to see if I can maximize the upside, and I can take a little bit that maybe I could afford that kind of a drawdown and if it doesn't make it, but I like the odds of seeing if it's going to grow my money that quickly.
Right. So definitely on those higher returns, just for our investors, those are in the higher return side. When you're looking at our investments, you're going to see K2, Denali, Kilimanjaro is in there as well. And you will find that they actually do still have a better risk profile than the indices most of the time. The index that you can compare them to. In the app, you can compare them to the S&P and the Dow right now, so you can actually see them side by side. Um, and then sometimes a fund lowers risk but gets a similar return to the index. And I think, if I'm right, Victory Peak is looking like that right now, right? If that's
Right.
correct.
Victory Peak offers a good steady return, has over the last 5 years averaged around 12, 13% in the past 5 years. And the volatility is something that's slightly less than what you'd find on the S&P 500. So we do have several different flavors, and again, the ability to build a portfolio and see the stats of the portfolio. And once you get to a scenario that you like, then that's when you can lock it in and say, okay, this is the strategy that I'm going to go with and a portfolio that I want to go with.
Yeah. So I guess we're saying that whether you want to get rich or stay rich, looking at the risk side, you're probably right now not going to find on the Carl platform out of control risk, or, a really high, even above index levels of risk. But you can still find some really strong returns in our investments.
Absolutely. And again, the quantitative hedge funds, again, by definition, they build in risk protections into their algorithms. Each of them may take in different types of data. They may focus on a different universe of stocks. They may have different strategies. Some may be long short, some may be long only, some may be looking at commodities or futures. So there's really something in there for everyone. And again, the good news is we provide enough information about each of those that one can basically lean towards a profile that they feel comfortable with.
Right. So long only, when you talk about long only, you mean they're really looking for investments that are going to gain. They don't necessarily short the market, right? And then
Right,
so long short, again, this is in the Victory Peak. Kilimanjaro does still short, but they're in commodities.
right,
That when the market is down, they will sort of, in simple language, invest against the market, have a hedge in there, and so they can continue to grow and have gains when the market is down. So both types of investments are available, and some are combos. They do a little bit of both.
exactly.
So lots of different diversification options and different types of strategy utility for all the different types of investors, particularly the two categories we're talking about today. Any final words for our investors, or, whether they're looking to get rich or whether they're looking to stay rich, what Carl is, we want to make sure we're there for them,
Yeah,
wherever they're in their process.
yeah, absolutely, Jamie. I mean, one of the reasons that we started Carl is we feel like there's an unmet need out there for those that want to have the ability to invest in strategies and build portfolios that exceed the capabilities that they might have with mutual funds or ETFs or other more common and traditional investment strategies. So we're democratizing the availability of hedge fund investing, which is something that has, before Carl, been restricted only to the ultra high net worth individuals. And typically those funds are going to be locked up for many years, typically very high minimums, $500,000 to $1 million at least. And Carl offers very low minimums. You can invest with as low as $20,000 if you like, and you can get in or out or change up your portfolio in less than 30 days. So those are some of the unique aspects of Carl, and we're very excited about bringing it to the marketplace. And it's really just about creating the awareness as you're doing with these podcasts. So thank you for doing this.
Yeah, we're trying to let people know. What, the one thing we didn't talk about today, and I know we were on the final word, but I have to do it because you mentioned it right there, and I get the question all the time, so I'm gonna have you address it. We'll have one final word, which
There we
is,
go.
I do sometimes get asked, like, well, why don't I just go into a mutual fund? So can you just give us a moment on correlation and how the Carl funds, we are really focused on making sure our funds are uncorrelated, and that's a big deal when you're talking about mutual funds versus hedge funds, et cetera.
Absolutely. So mutual funds are long only. They're regulated differently than the hedge fund strategies would be regulated. They can't go short. There are a lot of investment opportunities that they cannot engage in simply because of the regulations. So quantitative hedge funds, or hedge funds in general, they're basically allow you to short the market or short certain stocks when the market is going down. The only thing that mutual funds can do when the market is going down is get out and get into cash, or they may just stay in and ride them out for the long term, in which case those investors are going to experience significant downturns, as we've seen when suddenly the market changes from a bull to a bear market. And many investors have been caught off guard at various periods of time throughout our history. With Carl's hedge funds, the ability to get in and out very quickly, and our managers are looking out for that constantly. Definitely. At their universe of stocks, they're going to protect investors from those kind of sudden shifts and changes that could lead to dramatic losses.
Great. Thank you so much for that. So obviously diversification in Carl funds, we are really keeping an eye out and making sure you have all the options and have a lot of protection no matter what the market does. Thank you so much, Cy, for chatting with us today. Really good to hear from you. We hope to hear from you more often. Investors, thank you so much for joining us, and we will see you next time. Bye-bye now.
Thanks, Jamie. Thanks, everyone. Bye-bye.
Thank you for listening to the Invest with Carl podcast. The views shared on this podcast do not necessarily reflect the views of Carl. This podcast is intended for informational purposes only and is not intended to constitute and should not be deemed to be an offer to sell or a solicitation of an offer to buy any security or investment, financial advisory, legal, tax, accounting, or other professional advice. Carl funds are currently available to accredited investors with a minimum investment of $20,000. To learn more about Carl and to download the Carl app, go to investwithcarl.com.